Hello everyone, I'm Namrata and welcome to another episode that we have created for you, and today we are going to talk about seasonal funds. Now in our previous video we spoke about all season funds, so funds like your large cap, mid cap, flexi cap, multi caps and so on. Now these funds are definitely lesser in terms of volatility, but a lot of people would consider these funds to be boring or less exciting. Now the next segment of funds that we are going to discuss in this particular video are the seasonal funds. So seasonal funds are funds like small cap funds, sectoral funds, thematic funds and so on. Now these funds generally bring excitement to an investor's portfolio. So seasonal funds have, if invested at the right time, have the potential to generate great returns. So now the question is, as an investor, should we chase potential returns or should we look at funds or go for funds that have the potential to give us stability in terms of returns? Now to understand this, let's dig a little deeper into seasonal funds. So now let's look at what are small cap funds. So small cap funds basically invest in small cap stocks. And what are small cap stocks? So all the stocks are given a rank based on their market capitalization, and the stocks which have a rank of 251 and beyond are called as small cap stocks. Now in a small cap fund, there should be at least 65% allocation given to small cap stocks. Now, if you look at, there are close to 2,000 stocks listed on NSE and about 5,000 stocks listed on Bombay Stock Exchange. But not all companies or not all stocks are viable for investment. So if you look at the performance of small cap funds, in the year 2014, for example, the BSE small cap index gave close to 70% return, which was much higher than large cap or mid cap funds. And if you look at Nippon small cap fund, that gave close to 96% return in that 1 year. These returns look very exciting, but there's another side to the story that we as investors should understand. So in times where the markets are volatile or during bearish markets, small cap funds or small cap stocks tend to lose out the most. So for example, in the year 2008, BSE small cap index lost close to 72% of the portfolio. Small cap funds generally tend to underperform. In many years, they have underperformed the large and the mid cap funds. Now, another big challenge with small caps is the liquidity. The liquidity in small caps is lower as compared to large cap stocks. And especially in bearish markets, there could be a selected set of small cap stocks where the liquidity is much lower. Therefore, the fund managers are very cautious when they're building a small cap portfolio, because even the investable portfolio in itself in the small cap space is quite limited. Therefore, we can conclude that small cap funds are highly volatile compared to large cap and mid cap funds, and they perform well in a particular market cycle. Therefore, the point of entry and the point of exit is very important in small cap funds. So small cap funds could be given a small allocation to better the returns of an all-season fund portfolio. Now the next set of funds that we're going to discuss is sectoral funds and thematic funds. So what is a sectoral fund? So a sectoral fund basically invests in a particular sector. As per the definition, at least 80% of the allocation should be given to the defined sector, which could be, say, pharma, IT, banking, etc. Now, one challenge with a sectoral fund is that the fund manager may not find too many stocks in a particular sector to invest in. And this could result into high concentration risk, which means a higher allocation is given to a few set of stocks. To understand concentration risk, let's look at an example. So what you see on the screen is the net assets of ICICI Prudential Pharma Healthcare and Diagnostics Fund. As you can see, the top 5 stocks hold 44% of the portfolio and the top 10 stocks hold 67% of the net assets. Now this is called concentration risk. So like I said earlier, generally concentration risk is higher in sectoral funds. Now one thing that all of us need to understand is that not all sectors perform at all times, which means in a particular business cycle, you'll only have a specific set of sectors that will perform. So for example, when the economy is not doing so well, or at times during recession, you would have the defensive sectors like your pharma or FMCG that will do well. And when the market or economy is recovering, you would have sectors like automobile or banking that do well. Now, if you look at the performance of the healthcare sector, from the calendar year 2015, consecutively for 5 years, this sector underperformed the market. But in 2020, because of the pandemic, this sector gave 61% return and 21% in 2021. Now, similar to sectoral funds, we have thematic funds, which basically invest in a particular theme and sectors belonging to that particular theme. So some of the famous thematic funds would be your infrastructure funds or ESG funds or export and services fund. Now, if you look at an infrastructure fund, for example, that fund would comprise of sectors like, say, cement, banking, construction, transportation, and so on. So an infrastructure fund would invest in all these sectors. Now, since thematic funds invest in a combination of multiple related sectors, the risk in a thematic fund is lower compared to sectoral funds, but thematic funds are more volatile as compared to other funds that we have seen in the all-season fund category. Now, let's look at an example of an infrastructure themed fund to understand the volatility that is possible in a thematic fund. So this particular fund, the NAV was 60 rupees on 1st of Jan 2008. But then the market crash happened and the NAV went down to 22. Now, for the NAV to come back to 60 rupees, it took almost 6 years in this particular fund. So imagine, as a lump sum investor, the opportunities the investor would have lost in terms of making money in these 6 years. As of Feb 22, this fund gave 43% return in 1 year, which means that just because it's an equity fund, you don't have to hold it for long term. So the key takeaway is that sectoral funds are volatile and very time specific. So sectoral funds and certain thematic funds should be a part of the seasonal portfolio, and you should exactly know when to invest in the fund and when to exit based on if the fund starts stagnating. Now, what are some of the other funds that we could invest in the seasonal fund portfolio? So in the seasonal portfolio category, we could look at international funds. So, we generally invest in a lot of mutual funds to diversify our risk. But India's country-specific risk cannot be diversified to a large extent if you are investing only in domestic stocks or domestic funds. Now, to cut this particular challenge, we could look at investing in international funds. Now, international funds come with a lot of benefits because when you're investing in international funds, one, your country-specific risk is diversified, and at the same time, you get the opportunity to invest in a lot of international companies that are not listed on the Indian stock exchanges. So in the international funds category, there are different categories of funds that you could look at investing in. So for example, we have fund of funds. So fund of funds are basically funds where money is collected from Indian investors and invested in mutual funds of target countries. These funds are also called as international feeder funds. Then you have active international funds. So in active international funds, the fund manager invests directly in stocks of other countries which are not listed in India. And then you have geography-based funds. So you have funds which invest in a specific geography like US or China. So for example, there is Edelweiss Greater China Offshore Fund that invests only in stocks which are listed in China market. Now the biggest challenge with international funds is the exchange rate risk. Now the next is new fund offers or NFOs. So you could have a particular NFO that's been launched in a particular category which comes in the all-season fund category. But then you might just say that why should my NFO investment become a seasonal investment? So then there's a very interesting saying that a known devil is better than an unknown friend. Now in case of an NFO or a new fund that's launched in the market, you don't have the track record of that particular fund, you don't have the history, you don't know how that fund has done in different economic cycles. So it would not make sense to put a higher allocation to a particular fund which has been just recently launched. Which is why you should put a small allocation to an NFO fund and then just invest later when you have a more buy-in into the concept. Seeking excitement and long-term wealth creation does not go hand in hand. There has to be a boring part to your equity portfolio to bring in that consistency in your returns. And that boring job is done by your all-season funds. Your seasonal funds require dynamic portfolio management, tracking of the markets, tracking of economic cycles to really get you the returns that you desire. So now the question is how to build our equity mutual fund portfolio. So all of us agree that seasonal funds are volatile and they follow a particular market cycle. So which is why your seasonal funds could be a small part of your portfolio in addition to your all-season funds. So 20 to 30% allocation of your equity portfolio to seasonal funds and 70 to 80% allocation to your all season funds, and this strategy is called core and satellite strategy, would be a good thing to do. Now, please understand, investing in mutual funds is not about finding the best mutual fund for yourself. It is really about building that best mutual fund portfolio for yourself, which will help you in wealth creation in the long term. So in our next video, we're going to talk about an introduction to debt funds and certain categories of debt funds that we're going to discuss. If you've liked this video, do like, share it with your friends, and of course, subscribe to the Groww channel. If there's any particular topic that you want us to cover, please feel free to mention it in the comment section. And another disclaimer, if we've used a name of a particular fund in the video, it is solely for the purpose of education, and we are not promoting, recommending or advising that fund. So thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.